Most people think you need a lot of money to get rich in the stock market. But here's the truth. You don't need thousands. You just need the right strategy. The rich know how to invest smarter, not riskier. And today, I'm going to show you how to use the same long-term investing principles that have built millions, starting from almost nothing. The stock market isn't a casino. It's a wealth-building machine, but only for people who treat it that way. If you're new to investing or you've been too scared to start, this video is for you. I'm going to walk you through the basics of stock investing, including how the rich use the market differently, which strategies beginners should focus on, and what mistakes to avoid if you want to actually grow your money. Let's dive into the fundamentals. When you buy stocks, you're buying a piece of a company, not placing a bet. The poor and middle class chase trends, meme stocks, and hype. The rich focus on business fundamentals, long-term value, and cash flow. You're not just buying a ticker symbol. You're buying a piece of Apple, Google, Amazon. You're not a trader. You're a part owner in the most powerful companies on earth. Start with ETFs, not individual stocks. Don't try to pick the next Tesla your first month in. That's not investing. It's guessing. ETFs, exchange-traded funds, let you own hundreds of companies at once. Example, VTI, which is the total U.S. market. VOO or SPY, QQQ for the tech sector. These track entire indexes, safer, diversified, and built for long-term gains. Pro tip, dollar cost average into ETFs monthly. You don't need to time the market, just stay consistent. Learn the difference, market order versus limit order. You don't need to be a Wall Street expert, but you should know how orders work. Market order buys instantly at the current price. Could be slightly higher or lower than expected. Limit order. You set the maximum price you're willing to pay. The order only executes if the stock drops to that price. As a beginner, use limit orders to avoid buying during sudden price spikes. Crashes are not crises, they're opportunities. Every time the market crashes, the news tells you to panic. The rich do the opposite. Stock market corrections and crashes are normal. They give you a chance to buy quality companies at a discount. If you're investing for the next 10, 20 years, a dip today is a gift. Think long-term. The market has always recovered and then reached new highs. Avoid these beginner mistakes. Even smart people sabotage their wealth by doing these. Panic selling when prices drop. Buying hot tips instead of researching. Going all in on one company. Timing the market or waiting for the perfect moment to start. Instead, automate your investing. Set it and forget it. Wealth grows with time and patience. Use the right platform to start. Not all investing apps are the same. Look for platforms with low fees, automatic investing, and fractional shares, like Fidelity, Vanguard, or M1 Finance. Apps like Robinhood are okay for learning, but not ideal for serious long-term wealth building. Make sure your platform lets you buy ETFs easily and set up recurring contributions. Invest consistently, even if it's just $50 per month. You don't need a big salary to start investing. The secret is compound growth. Money that earns money over time. $50 a month for 30 years at 10% growth. It's over $113,000. The sooner you start, the more time your money has to grow. Recommended book, The Simple Path to Wealth by J.L. Collins. A must-read for beginners. Conclusion. Build, don't bet. Don't treat investing like a lottery ticket. Treat it like a strategy. The stock market has made millions, not through hype, but through consistency, discipline, and patience. Start simple. Stick to ETFs. Learn the basics, and let your money work while you sleep. Drop a comment. Are you already investing or just getting started? Like this video if you learned something new, and subscribe for more strategies the rich actually use. Now, go and build your wealth.